Two brothers of the same family decides to enter into a transaction. Income tax authorities will never allow such transaction to happen without their scrutiny. That's what happened in the case of companies. Transactions between two different companies under the same parent companies always attract income tax scrutiny. But one simple adjustment in that transaction can save companies lot of taxes and let them sneak away from the eyes of the regulatory authorities. Let's say there are three companies: Company Singapore, Company India and Company Hong Kong. Now Company Singapore and Company India are owned by the same owners, while Company Hong Kong is a different company altogether. Now Company Singapore wants to sell goods to Company India to be sold in the Indian market. So instead of directly selling from Company Singapore to Company India, Company Singapore will sell the goods to Company HK at an unimaginable low price, let's say rupees 1. Now Company HK will brand the goods and sell them at an extremely high price to Company India, let's say at rupees 100. And the market price of these goods in Indian market is 100 only. So what happens here is Company Singapore will earn a very low profit because the product was originally sold at a very low price, and Company Singapore will have to pay very low taxes in the country of Singapore. Company India bought the goods at a very high price and the profit margins are almost nil. So Company India will pay low taxes or almost nil taxes. Now all the profits will be of Company HK, which is 99 rupees, and HK is a tax haven which will save companies lot of taxes. This will also save the parent company of the Company Singapore and Company India from the regulatory authorities' scrutiny because they are not dealing directly. And government of this country, to find out the truth about this company, will have to call for the data from this country, which is a long and almost impossible process looking at the current relation of these two countries. Now this is followed worldwide by almost every large corporation. BlackRock did it for intercompany loans, MACD generally does it via Luxembourg, and Kellogg's India did the same process with Pringles, where Kellogg's were transferring profits to bring Pringles to India, almost 50% to another country, and after a long scrutiny, income tax department said them to transfer only 4% of the profits instead of 50%.